Welcome to our discussion on everyone's favorite topic, income taxes. So, a typical income tax preparation flow chart is this, right? Where you start with your gross income. That's basically, how much total money you make gross, right? So if you have like a $40,000 a year salary, you would start with 40,000. And then you would minus adjustments to income, things that you pay for, like health insurance and all that kind of stuff. So that's your adjusted gross income, stuff that comes out, before taxes. So then you take your adjusted gross income and you take away all deductions and exemptions. So again, you can take away deductions for, having dependents, and you can deduct your mortgage interest if you own a home and things like that. And that becomes your taxable income. And then you base your tax rate on that, right? So you go and look up in tables, if you're in this bracket, you pay this percentage. If you're in this bracket, you pay this percentage. You take away any tax credits you might have, and then that gives you how much total tax you have. Then you can take away any payments or withholdings, because some people actually make like monthly or quarterly payments throughout the year. And that's a good idea for people that are maybe on a tight budget, so you don't get hit with this huge bill at the end of the year. And then that equals the amount owed or refunded. So let's look at a typical example. She's got, excuse me, I earned wages of 38,200. So that's her, her untaxed stuff, her gross income. She also received $750 in interest from a savings account and contributed $1,200 to a tax-deferred retirement account. She was entitled to a personal exemption of $3,900 and to deductions totaling $6,100. We can find her gross income, adjusted gross income, and taxable income. So her gross income is the sum of everything she earned. So that would be her pay, right? Plus that 750 that she got from interest on a savings account. Yes, you've got to pay taxes on income that you get from savings accounts and things like that. So that's her total, just a little under 39,000. Her $1,200 contribution to a tax-deferred retirement plan counts as an adjustment to her gross income. So her adjusted AGI, adjusted gross income, is basically that total minus that money, so 37,750. The reason why they do that is if you have a tax-deferred retirement, right? So it's like a Roth IRA. These are tax-deferred retirement plans. That money goes out before taxes, so it comes right off the top, and it's as if you made less money that year. So it's kind of nice. It's like tax-free. And then her taxable income equals that adjusted, that AGI amount, minus all of her exemptions and deductions, right? So she had the $3,900 exemption, the $6,100 deduction, comes down to her taxable income of being $27,750. Then she would look that up in a table and figure out how much she owes, right? So there's all sorts of calculations that go into this. Your marital status, whether you're head of household. Exemptions are a fixed amount per person, and they can be claimed for you and each of your dependents. Deductions are things that vary from one person to another. Like a standard deduction would be the standard amount you take for, there's like a standard health insurance deduction. It's a medical deduction basically. It's like you get a standard $2,500 each year kind of thing for medical bills. But if you had a year where you had a lot more than that, then you would do an itemized deduction for that instead of taking the standard deduction, because it would end up you had more expenses than that 2,500, so to speak. And that's really what it comes down to is, should you itemize? And it's always you itemize whenever at equals more than the standard deduction, right? So if for instance, these were all of her different itemized deductions that she could claim, like contributions to charity and things like that, it still added up to less than the standard deduction. So she's better off just sticking with the standard deduction. A progressive income tax is something where people with higher taxable income pay at a higher tax rate, and then marginal tax rates are assigned to different income ranges or margins. Sorry. In 2017, these were the marginal tax rates, standard deductions, and exemptions that we had here in the US. Now they've changed a lot since then, but you can get an idea of how the tax rate goes up based on the more money you make, right? And if you're single versus married filed jointly, married filed separately, and head of household. So there's head of household is the idea that um, you're married or you're living with a spouse and possibly dependents, and you only have one income. Then you become the head of household. If you and your spouse both make money, then you either are, married filing jointly or married filing separately. And the only reason you'd ever want to file separately would be if there was a huge disparity between income brackets, right? So if one person made a lot of money and one person made very little money, um, and you'd also have to look at the math, right? Like if one person was really close to this, like they made 75,000. And if you added in the spouses, it would bump you up to this bracket, and all of a sudden you'd be paying 3% more. Whereas the spouse's income was low enough that they were only, in the 10% bracket. Well, you'd have to do the math and figure out if 10% of their money plus 25% of, your money was less than 33% of everything pulled together. So you just kind of have to do the math, and that's what, tax accountants and tax preparers do for you. A tax credit reduces your total tax bill by the full amount of the credit, and then a tax deduction reduces your taxable income by the amount of the deduction, right? So the tax deduction basically says you earned less money, so your total tax is based on a smaller amount, whereas a tax credit comes off the amount of taxes you owe that's already been calculated on your total income. So that's the two big difference between those. So suppose you're in the 28% tax bracket. How much does a $1,000 tax credit save you? How much does a $1,000 charitable contribution, which is tax deductible, save you? Answer these questions for both, right? Well, the entire $1,000 tax credit is deducted from your bill, and therefore it saves you the full $1,000, whether you itemize or take the standard deduction. It doesn't matter. This is like a credit. It says instead of owing $3,000 in taxes, you only owe $2,000 in taxes. Now, by contrast, a $1,000 deduction reduces your taxable income by $1,000, not your tax, right? So let's say if you're making $50,000, it basically just says you're now only making $49,000. And if you're in the 28% tax bracket, then that means it only saves you 28% of that money. So if you take 28% of 1,000, it only saves you 280, right? So, and then you will only have this 280 bonus, right, or less tax if you use itemized deductions. And then if your itemized deductions are less than the standard deductions, then it'll save you nothing, right? So oftentimes tax credits are much better than tax deductions, but tax credits are much harder to get. Okay, another example. Drew's in the 15% marginal tax bracket. Marianne is in the 35% marginal tax bracket. They each itemize their deductions. They each donate $5,000 to charity. Compare their true cost for the charitable contributions. Okay, so the $5,000 contribution to charity is tax deductible. So his contribution saves him 15%, which is $750. The true cost of this contribution is the contributed amount minus the tax savings. That should be amount, not about. Or $4,250. For Marianne, who's in the 35% tax bracket, it saves her $1,750. Therefore, the true cost of her contribution is $5,000 minus $1,750, or $3,250. So the true cost of the donation is considerably lower for Marianne because she's in a higher tax bracket. So, Social Security and Medicare taxes. Some income is subject to Social Security and Medicare taxes, which are collected under the name FICA for the Federal Insurance Contribution Act. FICA applies to the following: income from wages, including tips and self-employment. It does not apply to income from interest or dividends or profits from sales and stocks. So an example, in 2017, Jude earned $26,000 in wages and tips from her job, waiting tables, calculate her FICA taxes and her total tax bill, blah, 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 right? Well, the FICA tax is 7.65% of that. Now we must find her income tax. All right, we get her taxable income by subtracting her exemptions. That's her total taxable income of $15,600. And then we figure out what tax bracket she's in, which would be 10%. On the first, 93.25, right? And then 15% on the remaining. Yeah, and in case you didn't realize that, that's how it works is you get it progressively, right? So the first clump gets taxed at that amount, then the next clump gets taxed at the higher amount. So when you land in a certain bracket, you don't just everything gets at that. The smaller bits get the smaller rates. Okay, dividends and capital gains. Capital gains are profits from sales of stock or other property. So if you sell a house, then you have to pay capital gains tax. Short-term capital gains are profits on items sold within 12 months of their purchase, and then long-term are profits for things that you had for more than 12 months, and that includes things like houses and cars, and it really technically anything. If you sold a book for $5, you're supposed to report that, although nobody does, right? It's just for the big things. Tax-deferred savings plans allow you to defer those income tax contributions on certain types of things. The IRAs that I talked about, the qualified retirement plans and 401ks. So you don't pay tax on the money as it goes in, you only pay tax on the money that you take out later. Basically, if you start taking the interest off of it when in retirement, then you get taxed on that interest, but you get taxed at a much lower rate because you have much lower income at that point, right? So it does end up saving you money in the long run. So suppose you're single, you have a taxable income of $65,000, make monthly payments of $500 to a tax-deferred savings plan. How do the tax-deferred contributions affect your monthly take-home pay? Well, the table shows your marginal tax rate is 25%. So each $500 contribution reduces your tax bill by $125. Now, while $500 goes into your federal tax deferred savings account, your paychecks go down by only $375. So that's the beauty of the tax deferred savings plan. It's almost like you're getting free money. So you definitely want to enroll in those as early as possible and really put as much money into them as you can, as early as you can, so that you'll have something in savings when you're ready to retire. All right, and that's everything we're going to talk about for income tax.